Amazon stock had a 10% drop in after hours immediately after their earnings call. Now it's gone back up a little bit, so now it's more like down 8 or 8.5%, but still horrible because they actually had a mixed bag in their earnings call for February. To sum it up, they basically showed strong revenue. They're up 13.6% year over year. However, shares dropped because of their massive, higher than expected $200 billion 2026 capital expenditure plan for AI. This is exactly the problem that people have been worried about with other AI stocks. And it's because of how much people are spending on AI, and they're not sure it can actually return enough profit to justify it. People were actually anticipating that it would be something closer to 146 billion, and it's instead going to be over 50 billion more than that. They're also laying off another 16,000 people, and their revenue guidance actually fell short of expectations, which is what partially caused the dip as well. So while AWS has looked pretty good, people are focused on them missing on expectations for revenue guidance and also their massive spending for 2026 on AI. So like the bull case, if you really wanted to convince yourself to hold Amazon or to get more, would be AWS. AWS is one of the pillars of just basically running the internet and is a core infrastructure, but they also have diversified revenue streams. They're still one of the top retail sites, if not the top retail site in the world. Their advertising is strong because of that website as well. They have the Prime subscription ecosystem, and maybe these AI, infrastructure investments could end up paying off. It's just a lot of money. And I think a lot of investors in general have been showing signs of being worried about these massive investments in AI when we haven't necessarily seen huge returns on it yet. So for the bear case, one thing you could look at is just how have they done even compared to, say, the S&P 500. Over the past 5 years, the S&P 500 has gone up about 75%. How has Amazon done over the past 5 years? Half of that. Actually, worse than half of that. At up only 32.86% over the past 5 years. The past full year, they're actually down 5.71%. Obviously, the recent dip did not help with that. The past 6 months, they're up 4%. Past month, down 4.45%. So, while they are getting a little bit of this back in the after hours trading, looks like tomorrow's going to be a rough day for them as well. I also like to look at the past 3 months, and the past 3 months is obviously the equivalent of a quarter, and past 3 months they're actually down 18.2 or 18.3%. So if you compare this to the S&P 500, which is the whole point of, I think, picking your own stocks is to at least beat that, you're doing a lot better with the S&P 500. You're more diversified, you're protected from, one stock cratering your portfolio if something happens or if there ends up being an AI bubble that bursts. But Amazon is it's one of those, it'll probably still have steady growth over time, long term, but if you're just looking for slow, steady growth long term, and you're obviously not getting any sort of dividend, as you can see, what's the point? Honestly, what is the point? You can literally just have the top 500 in the S&P 500 and just hold that. You can get a 1% or 1.5% dividend, and you can also be way more diversified and sleep better at night than if you just had a bunch of Amazon stock. There's always the case that Amazon could take off again and have another, resurgence, but how likely do you think that is? So if you look at how much money they're going to be spending on AI and it being over 50 billion more than anticipated, EPS and guidance being disappointing, their free cash flow is being strained, Alphabet and Microsoft are trying to compete with them when it comes to AWS when it comes to cloud infrastructure. And of course, the retail business is cyclical, which, we could be going into an economic downturn right now or at the beginning of one. It's just too much of a mixed bag for me to think, oh yeah, this is going to be great long term. I think it's a good company. It's still a great company. It's just because it's a great company doesn't mean it's going to get you good returns on your investment. Of course, none of this is financial advice. Please do your own research, and everybody's portfolio is going to have different needs.